This video will provide a walkthrough to the solution for exercise 14-15, which focuses on accounting for tax loss carryforwards. Here's the information for our problem. Baden Limited reports the following taxable profits and losses for the years 2026 through 2029. Now note, there are no temporary or permanent differences to account for to start with. The management of the company believes it's probable that future taxable profits will be available to utilize any tax losses carried forward. However, the company carries losses back whenever possible. Also, the tax rate changes are not enacted until the year of the change. This is important because it means that we will not be applying future tax rates in the year we recognize any loss carryforwards. They will be based on current tax rates. There are two requirements for this problem, so let's begin with requirement A, which asks us to prepare the journal entries to record the tax amounts for each year. Our first year is 2026, where we have $10,000 in taxable income or taxable profit. We're going to multiply that by the 2026 tax rate of 25% to give us current tax expense and payable of $2,500. So the company will debit current tax expense and credit income taxes payable for $2,500. Then for 2027, we also have a profit of $55,000 this time. If we multiply the 20% tax rate that's applicable to 2027, that's $11,000 in current tax expense. So the company will debit current tax expense and credit tax payable for $11,000. Now it's in 2028 that things change, where the company realizes a taxable loss of $112,000. Now remember in the data, management said that it wants to apply losses to previous years first or carry them back. Since the 2028 loss of $112,000 is more than the 2026 and 2027 combined taxable profits, we're going to be able to recover all of the taxes paid in 2026 and 2027. So that means we'll take the $2,500 2026 taxes paid plus the $11,000 2027 taxes paid for a total of $13,500 recoverable in 2028. We're going to debit income tax receivable and credit current income tax for $13,500. Now we still have some of that loss left. So if we take the $112,000 loss in 2028, add back the $55,000 taxable profit from 2027, and the $10,000 2026 profit, these are the carryback amounts that we applied against the 2028 loss. This leaves us with a $47,000 remaining loss carry forward to future years. So if we take that $47,000 2028 loss carry forward and multiply that by the 20% enacted tax rate for 2028, this gives us a $9,500 deferred income tax asset for the year. So the company will debit deferred tax asset for $9,400 and credit deferred tax income for $9,400. Now we move forward to our last year, 2029, where the company realized a $21,000 taxable profit. So we can apply that $21,000 against the $47,000 loss carry forward from the previous year. So that results in a remaining loss carry forward at the end of 2029 of $26,000. That's the $47,000 loss carry forward offset by the $21,000 income or profit in 2029. If we take that $26,000 remaining loss carry forward and now apply the 18% tax rate that's applicable to 2029, this means now that our deferred tax balance should be $4,680 at the end of 2029. And because the beginning balance from the previous year was $9,400, we need to adjust the deferred tax account by $4,720. So the company will debit deferred tax expense for $4,720 and credit the deferred income tax asset by the same amount. Now for requirement B. This asks us to repeat part A, but assuming now that management does not believe it's probable that future taxable profits will be available to utilize tax losses carried forward. So if we go through the years 2026 and 2027, they're the same as requirement A. Those years both had profits, so we simply calculate the taxes payable each year as we did previously. $2,500 for 2026, $11,000 for 2027. No changes. In 2028, the company had a loss of $112,000, but because management does not believe it's probable that future taxable profits will be available, all we can do is apply those losses backwards. So as we did in requirement A, we simply recovered those taxes, $2,500 from 2026 plus $11,000 in 2027. That's a total of $13,500 recoverable. So the company will debit income tax receivable and credit current tax income for $13,500. And because management does not believe it's probable that future profits will be available to utilize any losses, we can't record a loss carry forward. So there's no journal entry in 2028 for the loss carry forward since it's not probable that those losses can be utilized. As a result, we'll have a disclosure in the notes stating that there is a $47,000 unrecorded carry forward loss. And then for 2029, this is when the company had profits again. However, there were sufficient loss carry forwards to apply against that, so there is no current tax expense for the year. And even though there is still an amount available going forward, we still cannot record a loss carry forward deferred tax asset because utilization is not probable. So what we would see is a disclosure for the current tax components, where the current tax expense would be $21,000 of taxable profit in 2029 times the 18% 2029 tax rate for total tax expense of $3,780. But because there's the benefit of a loss carry forward, we can wipe that out completely and there's no current tax expense. The other part of the disclosure will be the remaining $26,000 unrecorded carry forward loss. And that's it. We're done with this problem.